Hey everybody, this is Jose Blasco here. We are about to get started. It would be very good to know that you hear me well, meaning that all is good with sound and everything, so we can get started into this session. As always, everything should be fine, but it's always good to have this final conversation before we get started. So please, quick sound check, quick message on the chat box, quick hello. That would tell me that you hear me. Thank you so much. Maka, good to hear you. Good to see you. Very good. We are about to get started. Hello from the bottom right corner of the screen. Good to see you all. We are live. Ready to get started, ready to do some trading. How are you, Joanne? It's good to see you as well, Christian. Good to see you all. Let's begin. May-12, 2021. Options with options. Like every Wednesday and Thursday, isn't it? We are looking at the markets, looking for opportunities. Multiple things to discuss today with prior trades. You know, some of you were in the COP trade, and definitely that was a happy one. We need to talk about it because, you know, there was a little bit of a surprise at the end of the day that we need to discuss together, and then we'll get into looking for other trades. Before we get started, disclaimer. On the upper left portion of the screen, you can see the disclaimer is being highlighted. Please read it carefully. This is important information. Do not skip it. Read it all. I am counting on you to read it properly. Thank you so much. And then when it comes to getting organized for today, so we just said hello, and it's a pleasure to be here, guys. And I also want to remind you all that we are simulcasting, and that means that, you know, depending on where you are, physically speaking, in which location in the world, but also which platform do you use to see the stream. Could be YouTube, Facebook, our private room, inside our website, tradewithufos.com/live. So depending on where you are, you may have more or less video lag, and this is something to keep in mind, especially when it comes to interacting on the chat box. And then also the fact that we have some of the streams that are public, where the stream in our private room is, as the name suggests, private. This also has an implication, which is our attempt to adapt to the main two groups in our community, the ones of you looking at trading more as a, let's call it a part-time thing, if that's a good way to define it, you know, meaning that, you know, you spend less time with it, you know, you are still serious about it, but you know, just a bit of training will do for you. So then definitely YouTube, Facebook is the way to do it, because it's totally free for you, and it's the same content that what we do in the private room. The difference in the private room is that the sessions are full duration, and therefore you get more quantity. And if you are like me, you know, never got enough, love trading, passionate, committed, devoted to it, so then probably that's the place where you want to be. So you want to come to our website, get into the coaching plans, and subscribe to the coaching plan, which you have monthly and yearly ways on how to do it. And if you do yearly, you even get a course for free and other perks for you to explore on the website. In any case, let's begin. We are going to be looking at the market. You may have noticed today volatility going up big time, so that hopefully will be a source of opportunities. So we're going to see that. So we'll be looking at the markets, looking at our prior trades, and from there looking into new trades to be built. So let's begin. Here is TradeStation. I start today with the VIX. Okay, notice we are talking about 24%. The VIX is up 11% today. So it's a pretty beautiful increase of volatility when looking at SPY, which is the S&P 500 index ETF. Not sure why it's taking a while to load. Hopefully it will show up soon. Yeah, it seems it's coming now. Here we go. So we can see, of course, the S&P has been falling after making this kind of failed all-time high, a little bit of a teaser, and then coming back down pretty heavily. Okay, pretty heavily. Even some of the UFOs that we had didn't really react to the fact that the climate changed from blue to red. And remember, in a down climate, sell on-field orders tend to be added, while buy on-field orders tend to be cancelled. So in that sense, we can see the market progressing to the downside. Statistics suggest 3 is the number. Today is day number 2. So today and tomorrow, we should expect a down day based on probabilities. And after tomorrow, probably Maybe we need to go as low as, those lower UFOs around 400, but at that point, we should see the market come back up. Okay, this is what we are, basically being suggested by the tools we use to analyze. So in trading today, when you have a market environment like that, well, obviously, it's either you get directional and try to catch those moves, or if you're gonna get non-directional, obviously with an 11% increase on the VIX today, the scanner I've been running for non-directional trades. Okay, if I show you the settings, I've been looking at top 50, not bottom 50, because we are looking for expensive options. Okay, given the fact that everything across the board has been gaining extrinsic value with the increase of the VIX. Okay, so we're gonna be looking at building iron condors today after I review the prior trades. That's how we're gonna start, given that volatility. Okay, if you are in trades such as the COP trade that we had for a while, then that increase of volatility is definitely helping big time those trades. So we welcome that. Thank you very much, Mr. Market. But if you are in the process of entering new trades, definitely it should be a better choice to plan on trades that are about selling options instead of buying options, meaning credit strategies instead of debit strategies, given the fact that prices for options across the board became more expensive. Okay, in any case, quick review of the COP trade. This trade concluded last Friday. Last Friday was, let me put the mouse in the right place, right there, 507. Okay, this is when the market closed. Okay, and if you recall, this trade was a trade where we could not lose money any longer after the multiple tweaks that we did during the life of the trade as part of our trade management rules. You could not lose any more, and I believe it was around $40 the profit we were going to make if we were to stay somewhere in the range. But what happened is that on the last trading day, price came to this UFO, and that UFO turned out to be very powerful, pushing prices very, very high, and most importantly above 56, which was the long strike that we own. We had a long 56 call. We also had a call about that, but that call was closed. Okay, that call was closed for 5 cents, and therefore when price went above the 56 strike, so what happened is that we were exercised automatically at the end of the trading day, and on Monday we found ourselves with that stock trading around 58. Okay, around 58, with 100 shares of stock delivered to us at 56, which basically provided an additional $200 of profit in this trade that was to be collected on Monday. Some of you emailed me and I told you just close the trade or have a trailing stop and just follow price to see how far it goes. And so whatever technique you chose to employ, that got you out for an additional profit on top of those $39 or $40. I don't remember the exact value now that we had before. So that was a nice trade. It was a little bit of an extra, icing on the cake at the end. That is not likely to happen. That on the very last days when you surpass your long strike, that is not so likely to happen, but it did happen, and we are certainly grateful. And thank you very much, Mr. Market. Having said that, this means that in future trades of this sort that we will put together, I also want to talk a bit more about what happens when you get assigned, what happens when you get exercised. This is something that we did not discuss past Thursday, because it was indeed not looking like past Thursday. The price of that stock was somewhere here. So it was not looking like it would go above 56. Definitely not. But then in the end it did, which again is a good thing. It's not a bad thing. But of course, when you get exercised, there's an impact on the amount of funds used in the account, and then also the fact that now you have a long stock position that you need to protect either with options or with stops, or you need to do something about it or just close it. Okay, so this is what we had, and that was the end of the story. Very, very nice trade with COP in the end, but again, maybe it was a little bit of a surprise to some of you that you were exercised over the weekend, last weekend. Okay, you guys feel free to comment on that. Again, assignment of options or exercise have this kind of, yeah, how are you, Siderman? Good to see you. Yeah, it's all good. We basically just started. So you haven't missed much. You were in this trade, by the way, Mark. We're talking about the COP trade, isn't it? So again, there is this kind of like myth about, when you do options trading and you get a sign or you get exercise, oh my God, what's going to happen now? But to be honest, it's not that big as a deal, at least the way I look at it. You just basically convert an options trade into a stock trade. That's what that means. And really the most important implication normally is in the form of use of margin or use of capital, depending if your account is a cash account, such as, let's say in the US, a 401k account or something like that, or your account is a margin account if you trade more actively. So that's the only implication. You go from owning a call that may have cost you $150, $200, whatever, to now you own 100 shares of stock at 56. This is going to cost you, or is going to not cost you, but you will need that money to maintain it on the account, which is $5,600, or if it's a margin account, half. So that's the implication. Okay. Normally, that's not an issue at all. Why? Because we never trade our accounts where all the money is utilized in trades and you got no extra buying power. It's never the case. So so then it's fine. And by the way, if you were to get exercised and then you didn't have capital enough in your account, so then your broker is gonna get you out of the trade, and basically that's what you want after being exercised, to close the stock trade. So of course you would get a margin call for that, but it's not that big as a deal either. So it's just an email received from the broker telling you, hey, we close your position because you didn't have enough funds, or maybe they are a bit kinder and they tell you, hey, if you want us to hold the position, you need to add funds before that date or before this time. So again, it's certainly to be respected and to be understood. What is it to be assigned or to be exercised? But in my mind, as long as you understand the implications, it's not to be feared, okay? And certainly every time you buy or you sell an option, even when you do spreads, you are at risk of being assigned or exercised, okay? Because this is something that I don't comment often because it doesn't happen often, and it's kind of, in my mind, it's obvious. At the same time, maybe I should comment more often, because while it's obvious, and precisely because it doesn't happen too often, sometimes it causes a surprise if it happens to you, and then you get nervous and you don't know what to do. So maybe I should comment on this more often. Maybe I should get a bit better at that. But basically, think about it. Let's say you do an iron condor and you got a call above and you have a call below. So it's very common that when you do an iron condor or a credit spread or a debit spread or whatever, we always think in terms of, okay, so what's the maximum risk? Well, is the distance between strikes, okay? And while that's true mathematically speaking, it's not exactly like that, because you get the maximum risk only if the stock was to go above both strikes. So this one gets assigned, this one gets exercised, and then you suffer that pain. But there are other cases where you may have closed a unit during the life of the trade and you are left with only one, which is the case of COP. Or another case, okay, which is the funniest, is when the market goes up, and stops somewhere there in the middle of the strikes. So you get a sign on one, but you don't get exercise on the other one. And on Monday, you find yourself either long or short stock. In this case, minus C equals short stock. So again, is that big as a problem? Well, not really. Normally, not really. I mean, of course, can you have a gap against you on Monday? Yeah, but you can also have a gap in your favor, and also you collected premium to be in that position. So again, if you are that concerned, you can certainly act on the Friday when you see that happen, and either get an option against your trade that is about to be exercised just to offset the risk and something like that. Again, on Thursday when we were looking at this, it didn't look like it was going to be ending up above 56, okay, and it did. And therefore, it may have been a surprise to some of you that you were exercised for a nice additional $200 profit. So again, really, we need to understand how options trading work. I may need to get a bit better at addressing that too, because it's not something that happens too often. At the same time, as long as you understand well the implications of your trades, I would like to propose to all of us to not to put ourselves in a position of fear when it comes to, oh my God, I'm going to get exercised, I'm going to get assigned. It's not about fear, it's about understanding what you got in your hands. If you understand what you got in your hands, there is no reason to fear. Of course, if you don't know what you're doing, which is not your case, but there are many people out there in the world that sell options, buy options, and they don't understand the implications, then of course, then that's to fear. Actually, we should fear those people. I'm not sure this is a good or a bad joke. In any case, hopefully this explains all of this well, and it's all understood by you, and therefore we can now move forward into the next trades. If you have any additional comments, feel free to type, and I'm happy to go back and revisit. Okay. Now the Dow trade. Okay, the Dow trade is a trade that we were planning on a trade on 5/6. That was last Thursday, and we said, okay, if price comes back to this UFO, we're gonna take the trade. Okay, and guess what? It did. Okay, it did, but it seems that it did after, not on that date, at least not after my vertical line, which is the time at which I was planning the trade. If I did it earlier in the day, great, but I was not doing it earlier in the day. I was doing it around 11 a.m. New York time. So notice that price came to the UFO. Thank you very much, Mr. UFO. Price was pushed higher. So all is good, all is beautiful. The question is on 511, okay, on 511, when price came back to the UFO, okay, what was the value of our EMA, which is the reference value? So on 511, we are here, okay. First of all, notice that would be candle number 6 instead of 7. It would be candle number 6 is one less out of 5. So we will be late with the climate. So it would not be advisable to get into this trade. And also the reference value is 67.14, okay, which certainly 67.14 is right under 67.27, is inside the UFO. So, in other words, you have one portion of our rules that would allow you to take the trade. And if you did, you can see the power of what we do. You have the EMA, you have the climate, you have the UFO, all of those things. So that's helping a lot, and that's why that stock is moving higher. But at the same time, if we were planning the trade that day, I would have recommended not to take it. Why? Because while the turning point took place, the bounce took place, we should not expect that trade to keep moving and moving and moving and moving in that direction. Why? Because, the climate is exhausted. It was already exhausted on the day of the entry. Okay, 6 out of 5 means that statistics suggest it's not going to expand any longer. So could it happen? Yes. Is it likely to happen and last much longer? No. Okay, so in this sense, while it's beautiful to see on the chart, okay, this is not a trade to be in, even though it's a good educational example that help us, kind of visually understand the methodology. Okay, so again, same question here. If you guys have any question or comment, happy to go back to Dow and review. And then the last one I want to review is TIM. Okay, and this one, unfortunately, I did not document well the trade, okay, because if you notice, I don't have lines on the chart, which is my bad. I don't know how I did that mistake, because normally I'm fairly organized when it comes to documenting on the chart, but I did not. Okay, and I do see that since we were in the sessions last week, so that stock came clearly higher and then went clearly lower. So we may have had an entry, okay, 5-6 was that day. The reference value was 227. So if I look at 5-6, and some of you may tell me, some of you, maybe you were watching this and if the trade met on entry or not. So yeah, so 527 is right here. Okay, right here. And if we look at, this is more or less the picture we had the day we were planning the trade. So if we look at when that UFO was hit, that UFO was hit on the next day, 507, and 507 tells us, number one, the climate was 1, 2, 3, 4. Okay, so 1, 2, 3, 4, 4 out of 4. So we were allowed to get into the trade, and the reference value was 225.75, which definitely lines up very well with this value. So yeah, that was a trade to be taken. Okay, that was a trade to be taken. Lower quality video, all looks good on my end. Siderman, you may want to adjust with the settings wheel the quality of the video. or maybe refresh your browser or something like that. It's looking okay on my side. Okay, Christian, you're in the trade with Tim. Very good job. I am not, okay, but at the same time, since it seems that we met entry and we met entry in a way that met the rules, so then what I would like to talk about is about trade management. Okay, so first of all, from a trade management point of view, we have okay, so let me go back to what the target would be when we plan the trade. So on 6-7, okay, so the target was located all the way down here, okay, but if we move to Monday, so that was looking good with the red UFO. If we look at yesterday, 5-11, then we can see that a new UFO was formed here, located at 216.57. Okay, so that's a bit unfortunate because that kills our profit margin. Okay, but basically, we need to be respectful of that green UFO, and that green UFO that didn't exist before and exists now, it's to be used as a target. So that would be 218.25. Okay, and that's obviously capping a lot of the profit of this trade. 218.25. So that would be the new location for the target. Okay, and let me see. So that was on the 11, and the 12 is right here. Okay, so we haven't reached that one. Okay, but basically what we're saying is that you should set a target, and Christian, you're in this trade. Okay, so you should keep this number in mind, 218.25. That should be the location for your target. So if that stock falls again, just get out. Okay, just get out at this price point, and that's it. Notice that on the 55-minute time frame we have another UFO which actually goes even higher than 218, but that's to be ignored. Okay, that's to be ignored because again we are assuming, even though the climate is now unconfirmed, we are assuming that we are betting on this down climate. That's the original bet, and we know in a down climate buy on field orders tend to be cancelled, so we don't want to be too concerned about that green UFO on the 55. But the one on the daily time frame, okay, that's how we set the targets in this type of trades, and therefore mechanically speaking we're gonna have to just get that target way closer than what it was. I believe originally it was like 211 or was it 211? Let me rephrase. No, it was much lower than that, isn't it? Yes, 171. Yes, exactly. Yeah, I remember we even said let's treat this trade like it's an all-time high, but in this case, kind of all-time low. Okay. Yeah. So anyway, good and bad news. The entry was met. The reaction was very good. Bad news, that stock is coming back up like it's going to the moon. So new on-field orders were added to the market. This is not happening because of magic. And we're going to have to respect those new on-field orders and move the target closer to entry. So this trade will end up as less profitable than expected, but hey, still a good one. Okay. So Siderman, hopefully your quality is now better. Joanne, really well. The session is coming in good for me. I'm very, very happy about that. Apart from selfishly speaking, Joanne, always extremely happy when you are with us. For you guys to know, and this is just me bragging about my teacher, my instructor. Joanne was my very first futures instructor many years ago when I took my very first futures course. So it's such a pleasure to have you with us, Joanne. So anyway, so we have all of this analyzed, okay? All of this is ready, and therefore is now time to look into trading opportunities. As I said before, given where the VIX is at today, I sorted, I scanned for non-directional trades with high value for options. I selected top, not bottom, and we're gonna start looking at multiple symbols and see, what are the various possibilities. By the way, I noticed that at least on my end, the earnings indicator from TradeStation is still not working well for me. I'm not sure why is that. It's really strange. But again, we have a backup plan. So, so VRTX, we're going to be using TradingView to find those future earnings date, which in this case is July 21st. The earnings took place on 29th of April, meaning that this is kind of like a perfect thing in the sense that we can use so many different expiration dates if we want to. So that's great. Okay, now where is that stock at? Okay, so the peak for that stock was reached in July 20. Okay, very good. So we got 50% probabilities when looking at regular session. When looking at pre and post market, we have 36, which that is not good enough. So we're gonna be going down a bit to find more UFOs above and below, and okay, I may have to load more data to get UFOs below. So let's load data all the way to, let's say, July 19. Okay, so July 19 to get more UFOs on the screen. So July 2019, and now we're going to be able to analyze the UFOs. In parallel, I know this is a stock which is not the most liquid stock in the world. So what I'm going to do is load the option chain to take a look, because maybe I'm spending time looking at everything, and next thing you know, liquidity is not on our side to take a trade. So I'm just going to be loading OptionStation Pro and look into that. Okay, so here is OptionStation Pro. It says please wait. We will. And now I'm going to type PRTX. Okay, and load that and see what's available. Okay, wow, I'm really unhappy about those spreads, and by the way, this is the monthly expiration date. So if we look at a weekly, I'm afraid it's going to be even worse. Look at that, 4 to 9. Wow, okay, got it. So we were about to waste our time big time. So anyway, let's move into Texas Instruments, which is the next stock in the list. Okay, let's look at this guy. Earnings was happening or has happened recently on Texas Instruments. It happened already. That was on April 27. So the next one is very far in time. So this is beautiful. Okay, now we only need the chart to meet our rules. We need at least 48%. So far it's not good. What about pre and post market? 34%. So we're gonna have to say no to Texas Instruments. So we're gonna be looking at Disney. So earnings for Disney, they are happening actually tomorrow. So we cannot do it on Disney. Electronic Arts, EA. Earnings took place on 11th of May. That was yesterday. And therefore that's beautiful, because the next earnings are going to happen way further in time. So let's take a look. With pre and post market, we got 40%, which is not good enough. When looking at regular session, we got 52%, and we do indeed have multiple UFOs above and below. So this, my friends, is looking good for us to plan a non-directional trade, and hopefully we're going to have the parameters meet our minimum requirements so we can take it. Okay, I am eager to trade. We had in the recent past sessions many cases of no go, and I mean, it's fair enough. The market is the boss and doesn't owe us anything, but certainly is more satisfactory when instead of no go we got a green light, isn't it? Hey Wayne, how are you, my friend? Good to see you. Very good to see you. So we got EA 147 to 132. Okay, so 147 to 132. Let's go ahead and draw a couple of lines. So 147 is more or less here. Okay, style dot, and we're gonna right click, create a new parallel, and 132. Oh, look at that. That may not be a good thing. Let me review that. Yeah, 147, 132. There's plenty of implied volatility on that. Well, actually, there is much less than what I was expecting. Okay, well, since we are dealing with $100 over stock and volatility is 54% on the front week, I'm going to try to do an iron condor that lasts for 2 days. Let's see if that one is going to work. The downside of doing such a short-term iron condor is that you cannot do anything. It's either it works or it doesn't. Okay, Joanne, you're so kind. And it works or it doesn't, but you cannot do much when it comes to tweaking and helping the trade with the trade management techniques that we use, isn't it? So that's the bad news. At the same time, the speed of time decay is very fast, and therefore the probability of ending up in a good position is good. You can also have a very simple technique which consists of closing the trade ahead of time. So maybe you sell it for X amount of credit and you close it for half, and then you can close it even sooner, and you kind of offset the problem that you cannot do management with closing it early, which increases your probability. Okay, so this is something you could do or you could consider doing. I cannot do May 21st because that's it is indeed doable with the red UFOs, but with the green UFOs it would force me to go all the way down below this guy. And when I look at the monthly time frame of electronic arts, there is nothing above because this is all times high. So the red UFOs that are available are the ones on the screen, nothing else. Okay, so I cannot do that, and therefore my only choice here is to explore if doing May 14, which is 2 days and a half from now, could work. So May 14 will bring statistics to 145, 134 more or less. So 134 is more or less here. 145 is more or less here, something like that. So that means that with this type of setup, I could go ahead and rely on this UFO and maybe that guy. Okay, so what's the vertical distance between here and here? Okay, what's the vertical distance? That's that amount, and if I project this above, we are almost perfectly centered, okay, if we use 133 something, 149, okay? So the question is really, if assuming the 149 is available, how much the 149 pays? We need at least 35 cents, remember that? So 149 pays 18 cents, okay, which is not 35, which we needed. Yeah, so it's gonna be a no-go, guys, with electronics arts. It's a shame because if we had more red UFOs, we could certainly work in a very flexible manner because there is no rush when it comes to pick an expiration date, given the fact that earnings already took place. Okay, Walmart is the next one in the list. Okay, so earnings for Walmart are happening on the 18th. Okay, on the 18th, and 18 is in the middle of next week. So in other words, the only way to do it would be to use the 14 as well. So again, it's another $100 over stock. Maybe we can, but notice that nowhere close we have red UFOs. So then it's not going to work unless we have good probabilities on the pre and post market data, which we do, and we 52%, but then the nearest we would sell will be 154. So again, I think the same thing that was happening with electronic arts is going to happen with Walmart. But again, I'm not going to take anything for granted. Doesn't take much time, to be honest, to check. And if the answer is yes, then it's a great advantage. So 154 pays how much? We got 155, it pays 1 cent. So yeah, it's way too far. Is not going to work. So Western Digital. Oh, and by the way, I ran the scan, way before the market opened. When things were way more quiet. So there may be new opportunities here. So while I'm looking at Western Digital, I'm going to rerun it just in case something new pops up, okay? So with Western Digital, first of all, earnings, WDC. So earnings took place already, that was on April 21st, April 29. The next time is going to be July 29. So we have plenty of flexibility with the dates. If I look at the monthly time frame, we got plenty of data above and below, so we should be able to find plenty of UFOs. So that is great to see. When looking at the 55-minute time frame, we got 36% probability with the pre and post market, so that's a no-go. So what about regular session? It's 44, and it's kind of like Murphy's Law, or kind of like the market playing a little bit of a teasing game with us, because in this case that I have plenty of UFOs and plenty of dates, then what I don't have is the probability. Okay, but hey, this is where patience comes into play. This is one of the reasons why trading is not for everybody, isn't it? Because some people will just kind of lose their patience and just go, and then they make no money and they wonder why, right? So it's important to stay cool, to understand that just like fishing, there are times you want to go out in the sea and fish, but maybe the weather is not adequate, so it's safer to stay home, where other days is a beautiful, quiet, sunny day, and not only you collect plenty of fish, on top of that you have a blast doing it. Okay, so the idea is to focus on your trading and think about it from this point of view, okay, and know that when you trade, there are times in the market where it's easy to put trades together, and almost every time you load a chart, you have trades. It was like that during plenty of last year because of the high levels of volatility. Almost every day it was like, yeah, here we go. If I want to have 10 trades, I could every day. Where there are other times, okay, where it's more difficult and it takes more patience and go through setups just to conclude the setups are not approved. Okay, and if that's the case, again, we just stick to the plan. So I'm gonna wait until this it's fully loaded. In the meantime, I'm gonna take a peek at directional trades. Of course, to the upside, I'm not gonna have too many. Okay, why? Because the S&P is going down, and if I look to the downside, I don't have too many either, even though the S&P is down. Why? Because when you look at the statistics for the S&P, if you recall, so loading the S&P one more time. Okay, you will see that in a minute. So I'll say it while it's loading. You probably recall that the down climates in the S&P are of a very short duration compared to the up climates on the S&P. Okay, the statistics are quite different. So in other words, when the markets go down, they do go down, but it's not like every single stock in the S&P follows down. That's the case when the markets go up, but when they go down, is not exactly the case, because notice that when the markets go up, statistics for the S&P is 863, when the markets go down is 285. Okay, so it's not a surprise that while we're in a down climate, it's not like every single stock feel the world is ending and everybody's going down. It's not the case. Okay, stocks are going down, but probably with not so much energy, not so much fear built in those stocks. So that's why we see it this way. Okay, so I'm just gonna load them. Okay, PTON. Okay, well, that one I don't even need to wait for the 55-minute time frame to load. That's a no-go for a directional trade to the downside, because statistics suggest that climate is down and confirmed. Statistics suggest 4 candles, and we've been traveling in that direction for that stock during 18 candles already. So there may be some major, fundamental news or whatever is happening to that stock to push it down the way it's going. But if you're selling now, you are indeed selling too low. And I'm not saying too low based on a subjective, comment. I'm saying too low from a statistical point of view. 18 out of 375 is indeed too low. Okay, so we're not gonna do it. PINS. Let's see what that stock has to say for us. Okay, and while it's loading, I'll have a quick look at non-directional. The non-directional actually gave me symbols that we saw before. So yeah, so we don't have a way to get more results. Okay, in any case, I'm gonna do something in a minute. Okay, because okay, let me explain one thing at a time. So anyway, so that stock is loading. We are also talking about 10 out of 5. Okay, so again, another stock less exaggerated compared to PTON, but also another stock that has been going down for a bit too longer, and therefore from a statistical point of view, it's too low. Moving into Twitter, and same story as well. Okay, so 17 out of 5. So guess what? If you are into short trades like Tim, congratulations. If you didn't get in, basically we missed the boat. We are late to the party today with the 3 symbols given. Okay, PTON, PINS, Twitter. we are late to the party. 17 out of 447. That means that's late to the party. Okay, so we are not gonna touch it. Okay, and you know, we could certainly explore directional opportunities to the upside and see what's available. Okay, but in any case, before I get into directional stuff, I want to comment on one more time non-directional. Okay, and I want to mention something that you probably know because I did say that before. This is a characteristic of the TradeStation platform. So if you load implied volatility value, okay, which is, you know, this built-in study called implied volatility all options. This is showing us currently 0.45 for Twitter, okay, and you could pick any stock you want. But if I look at this, okay, if I look at this on the option chain, okay, if I look at this on the option chain, okay, so notice that you got 63, 51, 49, 47. All of these, all of those values are more than 45. Actually, there is a little feature here on the option chain that I think I never mentioned before. If you right click and customize the column on the very top, there is one option here called VIX volatility that you could add. Actually, I have way too much stuff here, so let me get rid of a few things. Okay, so I'll get rid of these and these and these and these and these and these. Okay, actually the bid and the ask, I'll keep it. Okay. Here we go. And the high and the low, we don't need that. Okay, just to have less data on the screen so it's easier for you to read. But basically that VIX volatility, okay, that VIX volatility, which is currently 53%, is not the volatility of the VIX, okay? What this is basically the VIX formula applied to that particular stock to those particular expiration dates, okay? So basically it's looking at 3 expiration dates and it's looking at the money strikes and 3 strikes above and 3 strikes below and looking at implied volatility, which is weighted by the delta value and blah, blah, blah. So this is kind of like the VIX formula, how the VIX is calculated, but it's applied to that stock only. So in other words, it's kind of like the real-time value of what you should see here, which is 45, but if it was real-time, it should show 53. So why is it 53? Well, because I mean, we talked about it. You know, what happened to the VIX today when it went up 11%? So, you know, Twitter has more volatility than what we see. Okay, it has more volatility than what we see. What's the issue? When we use the market scanner built in TradeStation, when we are selecting implied volatility, you know, stock, you know, top 50, that stock calculation for implied volatility, okay, is based on that end of the day value, which is updated, you know, after the day is over on the prior day and doesn't update until the day closes today. So there is delay. Okay, in other words, you know, I'm pretty sure that with the volatility today, if this was real time, we would have so many more symbols that meet the criteria. So what I'm going to do then is just click OK and rerun the scan. Actually, I did this too fast. Let me cancel the scan and explain that because I did it, but I didn't explain. So notice I have unchecked, okay? I have unchecked implied volatility stocks top 50, okay? I have unchecked it, okay? And I am now running the scan without looking at this. The danger of doing that is that now I may end up with so many, okay? So many different symbols. And then I may need to be picky on how I select, and I may need to be, you know, keep looking back and forth here and there to make sure that the trade makes sense. It's a bit more tedious, a bit more manual, but this is how you get many more trades. I mean, you have seen in the sessions that many times I end up kind of stuck because I don't have a trade. You know, in my trading, I'm happy to be a bit more manual if needed to make sure I find the trades. Also remember that I discussed, I mentioned this before, and that when we are ready a bit later, maybe let's say a couple of months from now or so, I will add a collection of additional options analytics tools that will help to save a lot of the time. But I don't want to do it too soon because I need you guys to understand what you got in your hands before we focus on saving times. Now I want to do things a bit more manual, a bit more tedious, but it helps you to learn and build a strong foundation. Okay, so please bear with me on that as we are rerunning the scan, and we're gonna look at it again one more time. Okay, and by the way, since I'm doing this and it's kind of the first time I'm doing it, so I will not interrupt the streams on YouTube and Facebook today. So you guys out there in the public streams, don't miss it, since it's something relevant that I haven't shown before. Okay. Yeah. Joanne, why 55 minutes? Yeah, because when it comes to selection of UFOs, so what we present as relevant information in our survival to mastery courses, in all the courses, like could be the futures course, the stock course, the forex course, all the courses that we teach. So we present a different use of the time frames compared to what's commonly done by market analysts or multiple time frame analysis, the classical approach. So what we present is basically we present the use of minimum 2 time frames, where one time frame, such as the daily time frame in this case, is used to apply autoclimate, and that time frame we call it the common time frame. Why do we call it common? Because those time frames that we use for climate analysis are time frames that represent what most people see, what more people do, what more people uses, because we need more people to buy after we buy or more people to sell after we sell for our trades to hit our targets. So we want to use those common time frames that everybody uses when it comes to assessing the market conditions. So it kind of acts as a tool or a magnet to attract more people to get into a trade after we got into a trade. So we have higher chance of a continuation. That's what we do with the common time frame. But then in the middle chart, okay, we are using another time frame, okay, which is what we call the edge time frame. Okay, and here the idea is the complete opposite. Okay, and let me bring, I'm happy to share those documents with you guys. You just need to email me. I'm just gonna share a document on the screen. One second. Let me see. Okay, so yeah, so for example, these are the edge time frames that we use for futures trading. Okay, and we are doing stock trading, so it's simpler than that. But like I'm going for an extreme in futures, we have so many different symbols, and actually we also use shares and tick bars, right? But we have the common time frame, and then we have the edge time frame. And the edge time frame is either 2 minutes or 1597 tick charts. Or if you use the 60-minute for common, then you're using either the 8-minute for edge and then these numbers. And if you're using the 4-hour chart for a common time frame, then you're using 21 minutes and that. The next one in line, which is not here, is to use the daily time frame for common, which is what I'm doing with stocks, and then the 55 minutes for edge. Okay. So now, what's the edge time frame? Okay. And by the way, in case you have guessed it, all those numbers are Fib numbers. Okay. So the edge time frames are Fibonacci time frames. 55 is a Fibonacci number, and the idea is to basically find entry points where you can be as invisible as possible, because for you to buy, someone has to sell to you. For you to sell, someone has to buy from you. So the last thing you want to do is to use the 60-minute time frame, the 15-minute time frame, the time frame that everybody uses. You want to use a time frame that is not commonly used by people, but at the same time, you want to find on-field orders that belong to the large market players, and those large market players, they use computerized trading systems, which normally are based on Fib adjustments, including the time frames. So what we're doing is we're using a time frame which is weird, that no one uses, and it gives us an edge, because now not only you are more invisible entering the trades, on top of that, you are lining up your entries and exits with the entries and exits of computerized trading systems that belong to large market players, such as fund managers or institutional traders. That's why we're using 55. Okay, so long story to answer that question, which is definitely very powerful. I mean, the beauty of UFOs is that even if you apply it to a normal time frame, for example 15, there is artificial intelligence built in, and the tool will be adjusting itself to do as good as a job as possible. But again, when you use time frames like 55, 21, 34, so now you are also aligning yourself and identifying potential stack of orders added by those computerized trading systems that belong to institutions. Okay, this is what moves the market nowadays. Okay, I mean, it has always been the institutional side moving the market, but it's definitely not people, it's computers. So that's why we want to align ourselves with those timeframes. Long story, to end up with a list of 30 stocks that meet our non-directional criteria, but are not filtered by the cost of those options. Okay, so now we have to do some manual analysis when it comes to the cost of the option. By the way, Joanne, you're with me on that. It was a little bit of a long explanation, but hopefully that made sense to you. So we got ZM here on the top, Zoom. Okay, I sorted these, from more expensive to cheaper. And so how do I know if I want to accept this trade or not? Well, first of all, on the scanner, when I was looking for this variation of the scan, so what I have done is I have unchecked the top 50 from that stochastic calculation. I unchecked that. But I left as checked that I want the implied volatility to be greater than the historical volatility, right? So, those stocks should have some volatility, okay? They should have some volatility. Maybe it's not the top 50, but they should have some volatility, okay? So now, how do I know it's going to be good enough? I want to go back to the daily time frame, okay? Add my implied volatility all options, which is 52, and now I want to move into options Station Pro, add a zoom, okay, and look at that VIX volatility calculation and make sure it's higher. Okay, so let's see how much it's going to be for zoom. It should be more because the VIX is higher, but not always. So now it's 67. So, I mean, do I know for sure that zoom is one of the top 50? No. But what do we know? It's above historic. And on top of that, we got a little bit of a boost with the VIX going higher today. It's now pointing at 67% as VIX volatility. So that certainly motivates me to keep doing the research. But before getting too excited, there is one more thing to check, which is the earnings. So earnings for that stock are happening on June 1st, okay? And therefore, June 1st means that we could use 21st of May, 28th of May, but that's it. We cannot go beyond that because then just June 1st is there, okay? So looking good. So let's begin with May 21st, okay, and see what happens. Also, of course, I'm gonna have to look at the UFOs and the probabilities, because then if the probability is not 48 or more, then of course we cannot do it. So we got 52%. We got plenty of UFOs above, and I guess that if I load more data, we may have more UFOs below as well. So let's see. So what if I load data starting, beginning of 2020, for example? Okay, so beginning of 2020, first date, January 2020. Okay, so you guys, you need to know that everything I do in the room, it's always very conservative, okay, because I need you safe while you practice and you develop yourself. What I'm doing today, by scanning this way, it's more aggressive because I am not guaranteed as well that the implied volatility build the options is top 50, right? So I may start at a little bit of a lesser advantage, and that therefore is more aggressive. Now, doesn't mean it's wrong, especially if you are a bit more aggressive or you are open to a bit more risk. My main thing now is that you understand why I'm doing and why I'm doing what I'm doing and why I'm doing it, okay? So waiting, pending data for Zoom to load. Okay, let's see. We got 5 minutes left in the session, so hopefully we'll have a trade ready by then. And if not, tomorrow should be fun. The climate suggests, look at that, so many UFOs. Okay, so we should be good to have a trade here. Liquidity on Zoom is not the best, but you know, I guess it could be okay. So we're gonna go ahead and try. Okay, so Aaron Condor. Market makers are taking a little bit of advantage of that stock, to be honest, because you know it's heavily traded by retail. It's a company in the news, isn't it, or has been heavily in the news. Yeah, Siderman for Team. I will show that on the screen later on. We changed the target. It's a nearer target now for Team. I'll show you that later, okay? But basically, you know, when companies are in the news like that, often market makers take a bit of advantage. So you may see option spreads a little wider, the bid-ask spread, I mean. But then when you try to execute the trade and you go for the midpoint, surprise, surprise, you get filled easily. Okay? So we're going to try to accomplish that goal. So when looking at the range, 259 to 312, that would be the range if we use next week. So 259 is somewhere here, okay, something like that. So style, dotted line, new parallel, and we go for, was it 312? Yes. So is it 259 or 269? Okay, 259 and 3. Wait a minute. Do I have the right date here? No. Oh my God. Okay, got it. I was like, why is this happening? That doesn't make sense. Okay, now I got it. 312. Okay, so here's where we are at. Okay, so we got 51% probability. We got all those UFOs. If I look at pre and post market as well, 51 becomes 47. Okay, so it's not 48. So we're gonna stick with the regular session data, and yeah, and we can see that there is a UFO here, okay, located at 314, let's call it 315, and there is another UFO here, but this will be UFO number 1. So to do what we are supposed to do, we need to go to UFO number 2, and of course we try to be as close to the midpoint of the range as possible, and that means that I will likely need to adjust my upper UFO. So I am now calculating the vertical distance. I just clicked the wrong place. I'm now calculating the vertical distance between current price and the bottom UFO, and if I project this above, this will bring my line higher to here, and there is no UFO there. The next one is here. So, you know, if I was to position myself here, so let's try to adjust this below. Let me see. Yeah, here we go. So notice that if I use those UFOs the way I have it now, I am very fairly centered in the mid part of the range. We got multiple UFOs above and below, and this is a nice setup for us to use. Question is how much we get paid for the 335. So we're gonna find out this immediately using May 31st. So 335 pays 57 cents, which is indeed acceptable. Okay, so our minimum is 35, so that's good. And then on the bottom part we got 230. So when looking at 230, 230 is here. The minimum is 35, and here is 62. Okay. So the one thing I'm not happy about is the fact that the distance to the next strike is going to be $5. So this trade will need to have a minimum of $500 of risk. So that I'm not happy about, but I cannot change that. So let's put it together and see what happens. So we do 225 and 230. That's below. And above we do 335, and therefore I'm gonna have to go to 340 just to be equal. Okay, 335, 340, and this is providing 38 cents of credit, which is not acceptable because the risk is $5. We have a rule that says we want to collect at least 15% of that. That would be 75 cents, but we are only getting paid 38. Okay, so what do we do? Well, not an issue. We're going to move to the next date. We can do 28th of May, isn't it? So we move to 28th of May, okay? Probabilities now are going to be 320. So where is 320? 320 is somewhere here, so it's still good, okay? and the other one is 253. So 253 is somewhere here. So this is also good. Okay, so the same levels that we have identified meet you know, the statistics that come with this trade. So we are good. The question is, we had 230 to 25, and this happens to be the same. Okay, 230 and 225, we, you know, using May 28, we don't have like a 227.5, we don't have that. On the upper part, we have 335, and we should have 337.5. We do. Okay, but I'm not going to use it, so I can make this trade to be equivalent. Okay, so what do we have here? Okay, well, notice that, you know, we have again $5 of risk, and the credit collected now is more, is 52. But again, it's not meeting our rules because we need 15% of 5, which is 75, and in this case we are only getting 52. So it's not good. Okay, it's not good. Now I want to see why this may be the case, because liquidity is, you know, more or less okay. What about the 230? Yeah, 105, 120, $71. It's not that bad. It's not that bad. So I guess it's just the way they are priced. So, you know, I mean, since we got the trade in place, okay, let's do one thing. We're just gonna place an order. The bid price is $1 full. It goes from 1 to 10 cents. So we're gonna be very, very, very demanding, asking 75 cents. We are very likely going to not to be filled. See you, Joanne. Okay, we are very, very likely not going to get filled. But if we get filled, we'll get a very good price for this trade, given the fact that it currently is 55. So we're gonna try that, and we'll review it tomorrow. So I'm gonna just load it here on the platform. So we are trading, okay, Zoom. We're using May 28 expiration date. So we are right-clicking to sell an iron condor, and we are doing 340, 335 on the call side, and on the put side we are doing 225, 230. I got this backwards actually. Here we go. Now I have it as a credit. So selling 335, buying 340, selling 225, buying 230. No, selling 230. And okay, selling 230. Here we go. Now I have it. So selling 230, buying the 225, which is below, and selling 335 and buying 340, which is above on the call side. Here it says 50. Okay, I'm gonna ask for 75. Again, very unlikely we're gonna get filled. We're gonna make it a day order, but if I get filled, it's gonna be nice. Okay, so I'm gonna just place the order, send. Okay, so the order is here, waiting to get filled. Here's the Iron Condor, waiting to get filled at 75. We'll review that tomorrow. Last thing I'm gonna do to be visual, it's to just do a little bit of drawing. Okay, so today is that candle. The expiration date of this trade is May 28. Here we go. And therefore, what we're trying to accomplish here is to profit from the fact that that stock remains in the purple area from here to here. That's what we're trying to do. Okay. So anyway, again, we'll review this tomorrow, and we'll be looking at more opportunities and so on. Hopefully all of this is going well for you guys. You guys are learning. You guys are doing some practice on your own, in your own time. Just make sure you communicate, you pose your questions and so on, and we stay in sync. Okay, everybody? Good to see you all. By the way, Maka, if you're still with us, I owed you an email and I responded to you, and I also realized that I owe you another email out of the response from my email that you sent me. So just catching up. You know that sometimes it's difficult for me to catch up with emails, but I'm always on top of it, so unless I get distracted. So I'll get back to you, okay? Everybody, my friends, you guys take care, keep up the good work, stay safe, and I will see you tomorrow, same place, same time. Bye-bye, everybody. See you soon.